Hello everyone, welcome to this Friday webinar. Like all our webinars and events, where we try to add value to our viewers, clients, investors. In this webinar also, the intent is to talk the pertinent stuff of slowdown worries in the Indian economy. We have seen a lot of indicators by way of last 2 quarter results being low, GDP numbers slowing down, GST collection slowing down, rupee depreciating. All these slowdown worries are definitely concerning. So this is first aspect that we'll be discussing today. We have Mr. Arun Subrahmanyam, who comes with equity research background of more than 3 decades, and one of the most, I would say, apt speakers for discussing this aspect. And then the second part of this webinar, we'll be discussing about the outlook for 2025, because some of these worries could be temporary and some of these worries could definitely be concerning. So we'll try to demystify and dissect this from a first understanding fundamentals on the ground, and then how to take action in terms of portfolio strategizing from here onwards for the outlook that we kind of foresee for year 2025. Welcome to this webinar, Arun, formally. And we at PMS AIF World, as every Friday conduct such webinars for our clients to kind of do not leave them just with investment, but add a lot of content, knowledge, so that you can handle and manage their investments well, because being in investment is the way to actually build wealth, and that's what we believe, and that's how kind of we operate. So over to you, for your opening remarks on the first part of this webinar, which is slowdown worries. How do you kind of read these slowdown worries? How much of these worries are really concerning, and what are numbers telling you?
Yeah, thanks, Kamal. I thank you and PMS AIF World for inviting me to this webinar. Yeah, about slowdown. See, I'll tell you before I actually discuss the slowdown, which we know is now kind of deep set in, and markets reacting quite sharply to these worries in the last couple of months. We as a fund could see this coming. I mean, obviously, we didn't know that it will take so much time for the markets to correct, and we were actually slightly positioned with some extra cash most of the year. But usually, cash doesn't help unless you really go whole hog into cash, and then otherwise it really doesn't help you manage a portfolio. So luckily for us, we had some cash, but we were by and large invested, which actually served us well for the first 10 months at least. Now coming to the slowdown, which is probably obviously the question which you asked for. Yes, there has been a slowdown, which we could see it coming primarily because the revenue started slowing down across sectors. In fact, Q2, which ended in September, was the 6th consecutive quarter where we saw revenue growing in single digits. The last and now you have actually seen a sharp deacceleration in terms of profits as well. Having said that, one needs to see where the slowdown has actually come and why, probably how to differentiate this. First of all, the slowdown which came prior to March started coming in most of the commodity related sectors and things like that. Since March, we saw certain sectors still do well. If in fact, the OMC's profits still grew by about 8%, I think, or thereabouts in Q2, which was probably 10% or thereabouts in Q1. Now 10 and 8 are not great numbers, but still it was a growth. But the growth came in primarily in sectors like pharma, autos, IT, and sectors like those. But slowdown was quite evident in most of the consumer related sectors, which was very obvious, other than of course autos, and also in cap goods. Now, cap goods is something which could probably explain by saying that yes, there was this election which happened, so spending came down, and so there was a kind of a slowdown there. Q2 obviously was also impacted because of the usual seasonal factors of rain, and this time we had excess rains. So you could kind of explain that Q1 and Q2, the sectors which probably were an aberration were capital goods. But other than that, this consumer-related slowdown has been there for a long time. The commodity slowdown has also been because of global factors, and that's also been continuing for quite some time. So what do we see change going forward is probably one sector where I think you could probably see a change for the better is probably cap goods. I'm talking about sector, I'm not talking about stock prices. I'm talking about the sector could see some change because obviously the government spending, which had declined in the first half, that is expected to increase in the second half. It may not go to the levels which government had actually projected or estimated, but it will still be much higher than what it was in the first half. So that could act as a kind of a trigger for. Obviously, it also depends on whether the tendering translates into order flows and all that. But that should actually as a trigger for the sector. And in terms of the execution of the projects were already in hand, you should see that translate into earnings for that sector starting to pick up from quarter three. IT is one sector which should do well in the second half, but having said that, there's obviously this whole seasonal thing. Quarter three is usually a weak season, so that will play out. But quarter four onwards, we think IT should probably be one sector which should do better. There are also a couple of other smaller sectors which are facing reasonably good demand, but they're very small to actually talk about right now. The concern remains obviously in the consumer-related sectors, and that demand, I think, is going to. We were expecting some kind of bottoming out in the last quarter, which really hasn't happened. Festive demand has been weak in many of these segments, and that probably demand will take another maybe a couple of quarters or even more to start seeing significant change. The good thing is that the RBI is now started recognizing some of this. We saw some kind of impetus in terms of CRR cut, which would start to see some easing in terms of or improvement in terms of credit growth, and further monetary easing, which probably translate to better improvement, but that will happen with a lag. So most of the improvement which people were expecting in the second half in terms of the consumer-driven sectors would probably have to wait for at least 2 or 3 quarters to see that happen. So the way one would, I think I'm going overboard in terms of trying to explain what sectors and all to look at, but I'll stop here. That's my opening comment.
No worries, Arun. So if we further kind of, want to deep dive now, that as you mentioned that, last 2 quarter kind of sector-wise revenue growth was slowing down. Let's maybe, try to understand fundamentals. Why did it slow down? You said that you saw it coming. You were quite kind of prepared for that. So what were those triggers, and why I'm asking this question? Because I wanted to also address some of the points which you see now in future, which are like maybe self-correcting.
Yeah. See, like I said, I'm not an economist, but a lot of the economists also, I'm very sure, could see this. There was a lot of credit tightening. There are a lot of regulatory measures which were put on the financial system, whereby this slowdown was happening. You really didn't see the amount of flow going to credit flow going to the manufacturing sector, and you could actually see that slowdown was coming. The second thing which I also explained was the election and the heat wave in the first quarter, and the excessive rains in the second quarter, which actually impacted demand. So those are the two big things which at least the rains one could not forecast, but the rest of it one could see much earlier.
Sure. So going ahead, how do you read the quarter 3 numbers? Do you think the way markets have behaved in this week, especially today, markets are worried about the Q3 numbers, which would be coming in maybe, 15 days from now. And I'm sure you would have also done some kind of estimation.
Yeah. So see, quarter 3 is seasonally good for certain sectors and not so good for some sectors. those sectors which are actually doing well are actually starting to recover, but will not see that kind of numbers in quarter 3 would be IT. IT seasonally is not a great quarter for. Sector 3 is not a good quarter for IT. But Sector 4, I think, will be significantly better, and therefore IT is something which I think you should probably, if one is not positioned already, should look at that probably softness in quarter 3 to probably get back into IT. Pharma is another sector which the demand seems to be okay, both in the domestic space as well as in terms of how the US generic exports are panning out. So that also I don't think is an issue. It depends on how one is positioned. Of course, even if hospitals, you see the number of kind of bed additions and expansion which has been happening, and that is actually helping that space. And pricing has been quite resilient there. So I think that's so healthcare as a class will probably continue to do well even in quarter 3 and beyond. The problems are going to come in most of the consumer driven, the consumer discretionary especially. You will have some kind of peaking out in terms of demand. Demand, in fact, never saw a sharp improvement in the first half. But what you could get in the first half was that there were tailwind in terms of margins, and that I think is probably not trying to peter out, because most of these companies are operating at optimum operating at reasonably high capacity levels, and the tailwinds of commodity tailwinds are no longer there. So you probably will not see autos doing as well as one would expect, what one had seen in the first half. So these are the 3 big sectors we can talk about. Banks, which had problems earlier because of all these regulatory issues, should start to see a kind of stable kind of numbers. I think PSU banks have shown some kind of resilience in showing better numbers compared to private banks. But otherwise, overall, banks should be okay. The first half had some impact in terms of credit costs going up, and now they've actually stabilized. So even the financial sector should be okay. So except for consumer, I think most of the other sectors should be okay. Overall, because of the way markets have weighted all these sectors, you would probably still see a situation where there is no sharp improvement quarter on quarter in terms of numbers. Whatever numbers you see in terms of improvement will probably start to come from quarter 4. In certain sectors, like the consumer discretionary or staples, it'll probably slip to quarter 1 or quarter 2 of next year, or maybe even beyond.
Sure. So every time it is said that leaders of every bull run are different. Like last bull run had leaders like Trent, Polycab, and some of these stocks, which today maybe are trading at very high valuation multiples. Do you see the same kind of stocks continuing the leadership in the maybe recovery or the subsequent bull run? Because these are also stocks which are there in your portfolio. Hence, particularly I'm talking about these stocks. Though I do not mean to kind of convey any advice or recommendation on any stock, but just trying to take this as an example.
So see, I'll tell you why. Since you took names of stocks, they represent the sector, but they were outliers. I mean, they did well in a sector which was not doing well, right? So I don't see any change there. But yes, the valuations are an issue, and those could be questioned. But typically what happens is, if what we are witnessing today in terms of some uncertainty or in terms of growth continuing for the next 2 or 3 quarters, these outliers will continue to remain outliers. In fact, I won't be surprised if the premium at which they trade probably expand for good or bad, for good or worse. So I don't want to talk about these 2 companies per se, but I can talk in a different forum. In terms of leadership, see, IT and pharma are the 2 spaces where we had moved some of our exposure to pretty early. But we wish we had done a lot more than what we had done. Of course, that's also always in hindsight. But still, we are reasonably okay in terms of satisfied with what we have done. So those two sectors will continue to be betting on them, despite the fact that that space also is seeing some richness of valuation coming, because that switch in trade has also played out in the last quarter or so. So it is possible that those two sectors, especially IT, for example, some of the good companies correct after the quarter 3 results, but we would be probably looking at that space for further appreciation in calendar 25. So that's two. But see, I'll tell you what, Kamal, the thing is that since you said sectors take leadership, it is not necessary that, a pharma or an IT takes leadership. There could be pockets within that which probably score. For example, I'm just giving an example. In pharma, there are so much to choose from, right? And then there's domestic, there is the US generics, there are hospitals, there are diagnostics, there are, and all that. And, CDMO. And of course, the latest one, of course, which I think I had spoken to you some time ago in one of the separate forum, is this whole thing of these semi-glutides becoming a big opportunity for Indian companies when they go off patent in 2030. But of course, ex-US, some of them actually start going off patent in, some of them you can actually start to participate in 26 and early 26 and 27. So that is one opportunity which we like. And obviously, it's not going to be an opportunity for 26, but it will be an opportunity for 27 and beyond. So one has to play these kind of narratives if you want to really, do well over a longer period. See, calendar 25 or fiscal 26, whichever way you look at it, is going to be a very difficult year. It is going to be very, very stock specific. And the way markets are behaving today, there is the sectors which are actually doing well. They really don't represent, very large spaces. They are sector, for example, the capital market space. It is something which was always there. But, now those companies have actually, it's still a huge opportunity. But the question is, after having participated so much in calendar 24, whether you expect them to do the same in calendar 25 is something which is very difficult to predict. But we'll continue to like them, maybe not as much as we liked them earlier. But it is, like I said, it's very difficult to make a case for large sectors to do well in calendar 25. There will be various pockets which will do well. So it will be so that essentially means it will become a very, very stock specific market. Until you see broad recovery or revival and things like that, then of course you can actually have a much wider choice.
Are you betting on broad recovery or further accentuation of this fall?
See, which is what I said. The market, let's not get into the market fall. We are talking about broad recovery. I think broad recovery, if you had asked me this 6 months ago or 3 months ago, I was saying quarter 4 onwards, you probably start to see recovery. I still maintain that some pockets will see that. But the broad recovery, as we see today, I don't think is going to come before second half of next year. I'm talking about calendar second half of next year. I don't see that coming, or maybe even Diwali of next year, which essentially means that even if stocks were to start to recognize that, they will start to recognize it only a quarter earlier, or maybe March or April, which in some sense tells you that maybe January, March also could be quite painful for markets, especially it depends on how they are positioned. Of course, if everybody is holding capital market stocks and the EMS and things like that, then they are very happy. But those are opportunities where you can't keep on betting every day.
Sure. No, I agree with you. Markets have turned narrow. It happened, in 2018-19 also. Obviously, when earnings slow down, the next step is always that market turns narrow, and only those sectors, and within those sectors, those businesses which are kind of still delivering good or maybe expected to deliver better, are the ones which hold on. Others take sharp beating, and that is what we have seen, within various sectors. And you are kind of claiming that it seems to be continuing for at least 2 more quarters, and market will remain kind of very sharper in terms of stock-specific actions.
Yeah. See, in IT, obviously I've said that, Costa seasons, I've just mentioned season quarter 3 and quarter 4. But, the whole thing about IT, if you look at it, IT peaked in 2021. Because obviously there's this entire this whole interest rate scenario, the interest rate cycle went up, and demand hit the bottleneck, and then obviously all the IT sector went into a downturn. And then, of course, you had a lot of these attritions and hirings had stopped. That whole cycle is reversed. I mean, if you actually look at how IT companies are now started to hire people, which obviously means that they are obviously expecting demand to recover going forward. Hiring has improved. US economy as such is suggesting that the slowdown which most people are expecting with that kind of tightness in labor market, that US market is not going to see that kind of slowdown. So demand for IT companies is going to be reasonably good. But again, I'm not saying that IT as a sector will do well. That's why you should look at the large caps and all that. So it all depends. There also you could have your own choices on what companies you actually look at and where you want to invest in. But that is one reason we actually still like IT.
Sure. Another sector which is private banks, which at one point of time was ruled by all well-known banks like HDFC, Kotak, Axis, and maybe Indian Bank also at one point of time. They have seen both price and time correction for so long. Are you wanting to add those in your portfolio from here on?
See, it is possible that, one of the private banks you mentioned, maybe, I don't know, like I said, name's not important, that could do well. And even the large PSU bank, that could probably, numbers kind of suggest that that space will see, and because especially since the stocks have actually done quite poorly in the last many quarters, couple of years, those will probably do better than what they have done. There's obviously this whole technical angle. I mean, most FIs hold these stocks, and if they're selling, where do they look to sell? And they obviously continue to sell the same stocks. So that's a technical angle. But yes, there is a case for looking at some of these large banks, both private and the PSU. As far as we are concerned, we own one of them, and we've been owning them for 7 years actually, and maybe it's too long. But in our case, we don't want to switch from one to another because we really don't think these banks, however much they have seen a time correction, we really don't think really creating that kind of major alpha over the next 2 or 3 years. But next year, yes, there is a case for looking at some of them, and we'll probably review it as we go along.
Sure. We have also seen, market in last, 10 years has been kind of moving from value to growth to quality, and then to value to growth to quality. So when market valuations actually grow, and in last, I would say 3 years, quality has actually underperformed. There have been many fund managers, who were proponent of quality, but maybe, in last 3 years, they underperformed. Do you think that now ideally quality should perform when, things are like becoming uncertain, rupees depreciating, geopolitical scenario is like, kind of geopolitized by kind of expectations coming from Trump, which could be again riskier for the world economy. And hence in this scenario, like I am reminded of a scenario which is like same December of 2019 when pharma was becoming attractive, IT was looking attractive, and then in March of 2020 we saw 30% fall, and then it was discovered it is a lockdown and it is a COVID. Before that, markets were able to see that, but obviously none of us was able to see that. Do you think such scenario is building up, and hence maybe moving to quality makes sense, and maybe hence this is a kind of a comeback of quality?
So it also depends. Why I partially agree to what you have said. It also depends on what kind of quality names one is looking at. For example, there are quality companies which are facing a lot of challenges in terms of competition, in terms of growth just being missing. And while many of them have seen, and some of them have seen time correction, but probably not price correction. Or maybe even if they've seen price correction, they've not seen a valuation correction. This combination. So I would not really therefore say that all quality will do well. One of the reasons, I unfortunately have to take that example. One of the reasons we still hold trend is because it has both. It has quality and growth. Now, obviously, one of them, if growth starts to miss, and then we'll have concerns over valuations, and then quality doesn't matter. It's a combination. So you basically, as long as there is quality with visible growth. I mean, it does not really have to be, stupendous or something. I mean, because most, like you said, most of them have actually seen a reasonably long time correction, and in some sense, I think the valuation differential between quality companies and not so good quality companies has narrowed a lot. So in some sense, that could make a case. But if the company's prospects have dimmed because, for example, Asian Paints 5 years ago was a dominant player, and today it still is a dominant player, but the whole competitive landscape has completely changed. Then you really have to question that.
No, understood. You're saying the definition of quality is always, visible growth, and earlier it was in some of the erstwhile quality businesses which were growing in the respective industries, like Asian Paints as one example, and now maybe that is moving to different businesses like Trend, for example, and hence though market could turn quality conscious, but quality is nothing but visible growth. Absolutely well put. Yeah. You want to add anything?
No.
Perfect. So moving on to the second part now. Which is like outlook for 2025, which you clearly categorized as three sectors you're looking forward, which is like private banks and some of public banks, then pharma, and then you also mentioned IT. So
yes, I'm sorry. I'll you finish your question, then I'll say sorry.
Right. So again, apart from these three banks, what are the, I would say, other apart from these three sectors, what are the other areas which you want to kind of add in your portfolio or you're looking forward to? Like there's a lot of, I would say, talk which has always gone about India's manufacturing sector doing well. Right, a lot of SME IPOs have participated in last 1 year and primarily have been coming in the manufacturing side of market, and that is something which is like maybe I would say new segment which is contributing to GDP. India has always been known as services economy, like China is known as manufacturing economy, US is a tech economy, and maybe in years ahead, India's contribution to GDP from manufacturing could increase, and hence, looking at this segment and then subsectors within manufacturing could also be interesting. So, I want you to kind of now maybe focus on what is the outlook for not just 2025, but next 3 years from here onwards, if you want to kind of restructure your portfolio in this, subsequent fall.
Yeah. So I'll just, okay. So what I wanted to interrupt you, then I'll say now. See, IT pharma is right, but the banks, we are nowhere close to being overweight and all. In fact, we have a very small exposure to one bank, and typically we don't invest in lenders. We have invested mostly in non-lenders, so that's been always our case. So we continue to hold that. Of course, the question therefore will be: will you continue to maintain that same kind of mix of lenders and non-lenders? That is something which is open to question. We have not done anything of that sort at this point in time because we continue to believe that the non-lenders offer better prospects over not just 26 for a longer period, except the valuations are where they are. The sector we like, other than IT and pharma, is the whole capital goods space, and that has actually done quite badly in the last year. We were significantly overweight in that space in the initial period. We pruned it down subsequent to June, but not because we saw a problem. Obviously, there was a problem because of this election and all which I mentioned, but it had done extremely well and valuations were quite rich. That has actually seen significant time correction. There have been some disappointments in numbers for the reasons I've already mentioned, but I think the prospects for most of them actually is reasonably good. And we've actually singled out power related capital goods as being something which we are excited about. Again, there are subsectors and things like that. I don't want to get in there, but that is something which we continue to like. They have not done much for us in the last few months, but we're holding on to it. We think at some point in time, if things start to become more visible in terms of the execution, we'll probably like to get back into it. So these are the three spaces we actually like. The rest of it is, like I said, we just they are fillers and we need to be there. And for example, we have a real estate company we like, because again, and if you have real estate at some point in time, we'll probably add more into building materials, because real estate with the lag, I think building materials will probably be one segment, which is again a very small segment of the consumption space that will start to do well. So these are things which you're looking at, not that we have actually invested in the subsectors, but that's how we have positioned ourselves. I mean, I hope I was clear. I don't know.
No, absolutely. So I was also, wanting you to cover on some of the, I would say, unlisted side, private equity side, or pre-IPO side of opportunities, because you have an AIF and you have fungibility and flexibility to invest maybe up to 20% in that side also, and because there's a lot of action happening, and probably you could get maybe better valuations there rather than maybe in listed space. Are you through your fund looking at that space, maybe not now, in future, and where I think a lot of IPOs are coming in the manufacturing side of segment, because today listed opportunities in manufacturing are less, and maybe the future India, if one has to kind of see it, maybe from 5 years perspective, could see more weights coming from manufacturing side of market, which is what everybody talks about, and which looks also in terms of how Indian economy is kind of moving ahead from today being services dominant to tomorrow maybe also seeing contribution coming from manufacturing.
So as a Cat 3 AIF, we have a disadvantage. We cannot invest in the private space. I mean, obviously, like you said, the 20% and all, there are some rules for that which we can lay down further. But just answering a question, yes, it's an interesting space. I mean, if you have positioned yourself, if you had a Cat 2 fund, or if you have positioned yourself as a venture capitalist who's obviously investing all these startups and all that, it's obviously an exciting space to be in. From our perspective, where we can invest in is where the IPO is pretty certain and it's about to be launched. We can actually participate as an anchor or all that. So we do keep exploring such opportunities, but the demand for those opportunities is so huge. To get allocation is extremely difficult. So that's the short answer to obviously a topic which can be quite extensive otherwise.
So you personally also have a pretty large allocation towards equity, and given your 3 decades of experience, yeah. So I'm just wanting to maybe understand your personal, I would say, inclination. Your portfolio allocation, I know, could be mostly in your fund, but over last, say, 1 to 2 years, you have also kind of added some money to pre-IPO, SME IPO, or private equity, or not at all. And why is that so?
No, I don't have time. In fact, the last 4 or 5 years, I've been a passive investor. I'm personally, I've hardly done anything outside. I just don't have time to look at it. Also, my personal portfolio is something which is just lying there. I mean, I just been like I said, I'm just not participating personally. So whatever money we make or we get as a fees or whatever, I try and reinvest part of that in the fund. That's because that's the easiest thing to do and the easiest thing to focus on. I mean, to do that, it actually requires a completely different mindset and a lot of time for that. I like I said, I really don't have that time or mindset at this point in time. For the fund, yes, I would probably, like I said, we have looked at opportunities. Me and my team have looked at opportunities, but we have not been able to crystallize or even be getting allocation for most of them. In 2019, we actually succeeded in actually getting a couple of allocations for companies which are just going to be listed. So that helped us. But of late, we have not actually got any such benefit. So all of what we've invested is mostly, all of it is in listed equities. And that's it.
Sure. Talking about, I would say few stocks. Again, I'm giving disclaimer. I am just wanting to understand your views because some of these stocks are quite interesting and they are in your portfolio. And for our learning sake, because you come from equity research background, who is better person than you to understand some of these, I would say popular and credible stocks. Let's talk about, say, Zomato, which is one of the stocks in your portfolio.
Yeah.
You're still holding it, and we have seen, it kind of having a very obnoxious valuations, but it's a stock which has done really well. Are you at any point of time looking to add more, or maybe book profits out of the stock? And at the same time, similar stock in terms of similar segment was Paytm, which kind of saw a very massive fall and a very, I would say, steep, very swift recovery, in this last 6 months. So, what are your opinions and thoughts about these two stocks if you have to particularly cover?
So first I'll talk about Paytm, which we don't own. We desperately wanted to own it and try to understand it, but we were not as successful as some of the lucky ones. So we could not invest in Paytm at the right time. Right time could be, of course, forget the lows it made. Even 3 months ago, one in hindsight could have said that was the right time. So we did not invest in it, and which is unfortunate. But Zomato, we've been invested for quite some time, and we invested in Zomato because it was a very exciting space. The reason we may not want to invest immediately or right now is because the fact that there are more choices there. Obviously, a lot of competition is coming in, and obviously there will be some kind of churn there of people looking at maybe exploring those companies more, or maybe preferring some of those companies more. But that's probably just a short-term situation. We think in terms of pure execution, Zomato is just a class apart. And despite, as you said, the obnoxious valuations, we think as a theme we should allow it to run for multiple years, unless you really see something changing on the ground in terms of its whole positioning, in terms of how it is losing out to competition. That apart, we don't see otherwise a big problem in the sector. So Zomato will continue to be with us despite the valuations.
Sure. I also see two very interesting stocks in my portfolio. One is Motilal Oswal Financial Services, and second is Natco Pharma. What are your views on these two stocks?
Yeah, so we have a bunch of companies actually. Like, since you are talking about the stocks I own, we have a bunch of stocks in that whole space where we think, not bunch, about 2 or 3, which we think can benefit from this the CDMO and space, as well as the themes I spoke about, the GLP-1 and all that. So Natco is just one of them. I know Natco has a problem. One problem which I think is by consensus, people think that there's going to be a kind of a cliff and there will be 2 years where earnings will get wiped out, which is true. But the fact is that it's probably one of the better companies which is better positioned in terms of cracking these big opportunities. And that's the reason why we have invested in it. There are a couple of other companies also we have invested in that entire CDMO and GLP-1 space. So it's just one of them which is there. The second company you asked me was which one?
Motilal Oswal.
Motilal. Motilal Oswal, it was again a capital market play, and not just capital market. It's just a host of things. It's a new capital market play. That's some and substance of it, but it's obviously got a distribution. It's got asset management company. It's got broking. It's got an unwanted housing finance business also. But overall, the valuations were so. It was so attractive that we couldn't kind of miss it. It still is not very expensive. Of course, it's somewhat expensive, but it's not very expensive for the kind of opportunities and where we see how the company can actually how it can grow. So we like that company still. We could have invested in any other company and we would have probably made similar, better, I don't know, somewhere here about that kind of return. But we chose to invest in Motilal also.
Sure. Within financials, you also mentioned that you do not have or do not like lenders. What do you mean by that, and why is that so? Because India as an economy, I think in lending is a very brilliant opportunity, and then
it is. But the reason why we don't, first of all, the reason why we don't do it is because of these regulations and too many regulations, and and top of that, the way to look at it is, why invest in a lender? See, as long as a lender is solvent and growing, you might as well invest in the constituents to where it lends, which will drive the growth, whether it's through manufacturing or wherever. So we prefer to do that. But better to do it through derivatives. I mean, how do we track, an economy which is growing at 6-7%, lending growing at 10-12%, and then delinquencies and whatnot? I mean, it's too much for us. I mean, that's the reason why we really don't look at that space very actively. I'm not rubbishing it and all that. As you said, it's a very large sector, and even a very large constituent of the Nifty is the financial space, both the NBFC and the banking space. We, like I said, if they are doing well, we'll rather go and invest in companies where they lend to, that's the way we've looked at it.
Sure. So they will lend to mostly, I would say, capital goods, or I would say manufacturing side of it.
Exactly.
Correct. I understand. So, that kind of takes us to the last part of this section, which, is the $1 million question everybody has on their mind. I'm sure you would also have some hypothesis, on what are going to be reactions of Mr. Trump finally coming into power and then doing some announcements, which could kind of derail manufacturing by way of some sanctions on some nations, maybe including India. So have you kind of given any thought to it, or, any, I would say, top level ideas, or I would say, views that you have on this?
Yeah, you're going to get me into trouble. See, first of all, I don't know. I mean, frankly, what Trump does, I think most Americans also don't know what he will do. See, the thing today, this whole talk about Trump will do something against China and impose restrictions and tariffs, and obviously certain countries stand out, China, India, because of the tariff structure and all that. And but I don't know whether it's probably part rhetoric and part he'll do something, but a lot of it could also be rhetoric, because he has to position himself and tell people that he means business. There will be a lot of noise. There will be some kind of action taken in certain sectors. And I remember last time when he was here, about 8 years ago, he shouted a lot about Harley Davidson and things like that. I mean, those are irrelevant, right? But it matters a lot for in terms of the noise bites, what it matters. But it really doesn't matter what we do for Harley or don't do for Harley. And how it impacts Eicher Motor at that point in time, which was the only premium motorcycle company. So it's very difficult to guess what he's going to do. But prima facie, it's just something which you have to live with, not just in terms of Trump coming in January or February, but for the next 4 years. Off and on, there'll be these these things will keep happening, and that volatility is something which we have to live with. To put a complicated matter, to dismiss a complicated matter, I mean, we've not really done so much of thinking to an already complicated and volatile situation as we stand right now. See, this market's falling today, and it's such a bad day actually. We have chosen to do this. The market's falling today. I don't even know it was because what the US Fed did yesterday, and yesterday we didn't fall as much. How the markets was positioned, I don't know. It was because of that, or it was just because of continuous FI selling, like they've been selling every day, or it was because there was some GST council meeting over the weekend and some people are fearing some things are going to happen. We don't know. I think it's a lot of it is because of all this positioning, combination of all this, which has resulted in stocks. Because today it was indiscriminate. I mean, good companies, not so good companies, they were all falling. So I mean, it's something which we have to see what happens. In some sense, it has kind of damaged sentiment. Yeah.
Well, I think the correction is most awaited, and many fund managers have been wanting
to. But I'm sorry to interrupt again. But the correction is this month. Mid caps and small caps are not down. Nifty is down some 4-5%. Nifty is down 5%, right? And everybody is saying Nifty has got value and Nifty is seen minimum downgrades, maximum downgrades have come in small caps, and so therefore small caps should do badly. But I think the problem is not problem. The thing is that money is gravitating towards these small pockets where there is a lot of excitement and growth and opportunity, and that's what people don't want to miss. Whereas they can't see that in most of the larger companies.
Absolutely, as you mentioned, markets are turning narrow. Within large caps also, there are not everything is falling, but it same is like with mid and small caps. But yes, large caps have fallen more. Having said that, moving on to I would say the last part of this conversation, where on your strategy, like you mentioned, markets have been falling over last 2 days. You have done nothing, but are you planning or preparing? How do you react? For example, if markets were to kind of now see a proper correction happening, as you mentioned, now sentiment has been adversely impacted, and that is how corrections happen. When sentiment gets impacted, the buying will slow down, and obviously selling will not slow down, and hence the correction will go deeper. And sentiment ultimately is going to spoil the buying. And if that is coming, and which is likely, and which is why some fund managers are sitting on cash, how do you plan to kind of react? Would you restructure your portfolio? Are you kind of already having some ideas which you want to kind of maybe add in a portfolio, or some you want to kind of change with, or you will just sit silent, or you're holding enough cash? How would you kind of react to such kind of falls?
A lot of sub questions actually there. So first of all, we don't have too much cash. We don't normally keep too much cash. We went to 10% or thereabouts prior to October and November. We invested. This month also we have invested, but usually on a fall we try and invest. But it's a different matter altogether that what we invested in October, November yielded returns for some time, have stopped yielding returns and things. That's a different matter altogether. But we have been investing as and when we get money from subscribers, investors. So we do that. But because we like I said, in the beginning itself, I said sitting in cash is not something we do we just don't want to do it, because essentially means that when you're sitting in cash, that one doesn't have ideas, and cash is not a good idea according to us. But yes, it does offer some protection, and it does offer you some kind of solace that when markets do crash, you can possibly try and invest. But I have seen in my own career that you don't do that. You typically don't invest in a falling market. You always try and invest in a market which starts to go up. So we are willing to sacrifice that situation. So we try and stay invested as much as possible. But what we have stopped doing is that now we have become very choosy in terms of looking at, even if we have new ideas, we just wait for markets to settle. Otherwise, we try and invest in some of our own stocks which have corrected probably more than it warranted, or the things like that. So in that sense, that's what we have done. Now coming to restructuring of our portfolio, no, we don't think we'll restructure our portfolio too much. Whatever I have said in this forum today is what we own and what we have continued to own, and we'll probably own a little less or a little more of it over time, but that's what it's going to be. We have increased our portfolio holdings, not number of stocks, by a couple of. We've added 2 or 3 names in the last 3 months. It's because we wanted to also diversify a bit. We just didn't want to be skewed, and like I said, we had done that a few months ago when we had too much of industrials and capital goods stocks. So we had to break that out and invest in other sectors. So that's what we have done. But overall, we have not really done something just because markets have gone down. We need to sell something of a portfolio or buy something else which is going up. We don't do that.
Sure, Arun. So I think it has been really a pleasure conversing with you. Like always, and to all the viewers, I would say that we at PMS AIF World have a very deep understanding of Ampersand Capital. In this forum, we cannot discuss everything, and few stocks that we have discussed are just ideas to kind of impart learning, not just it's not to be construed as any kind of stock suggestion or stock advice. We do not do that at all. Neither we kind of promote that. Every investor has to be very careful, in kind of taking very well-informed investment decision, and we kind of really always suggest that for all our clients. If any client who is watching this webinar is keen to know more about us, PMS AIF World, or wants to make very well-informed investment, or kind of wants to invest in Ampersand Capital, is most welcome to book an appointment with us. Thank you so much for joining on this Friday webinar, and thank you, Arun, for your time.
Yeah, thank you, Kamal, and thank you to the entire team for being associated. For us, allowing us to be associated with you, and we'll stay in touch.